Happy Friday. I'm Erin A. This is Boom Bust. These are the stories we're tracking for you today. First up, finally, the day has come. Peter Schiff makes his long-awaited debut on Boom Bust today. In today's show, Mr. Schiff weighs in on the Federal Reserve past, present, and future. Then we're taking a look back and highlighting some of the best hits from Boom Bust this past week. It's a Boom Bust greatest hits. You won't want to miss it. Plus, the effervescent Ed Harrison and I field your questions, comments, and concerns in today's In the Margins. It's the part of the show where we put you, the viewer, in the driver's seat. So please drive safely. It all starts now. Statistics Office confirmed Thursday that Eurozone inflation slowed in the month of December. Now, the ECB sees no immediate risk of deflation and wants to keep inflation below or close to 2% over the medium term. They've expected a prolonged period of low inflation. Now, the fall in inflation rates is linked to an overall economic adjustment and restoring of competitiveness of Europe's southern periphery countries like Spain, Portugal, and Greece, where growth collapsed during the crisis and triggered a massive austerity push. Elsewhere, initial claims for unemployment insurance in the U.S. decreased by 2,000 claims to a total of 326,000. Now, this is according to the U.S. Department of Labor. Now, this figure is the lowest level of weekly jobless claims since November of 2013, and moves the recent average number of initial claims down to 335,000. Now, initial claims were also lower than estimated. This time, just 1 year ago, initial jobless claims averaged about 365,000 per week. And finally, despite a modest economic recovery in the U.S., big box stores are struggling to compete with online retailers as the internet increasingly becomes the preferred form of shopping for consumers. Electronic retailers, and specifically electronic retailer Best Buy, saw an almost 30% loss in its market capitalization. Heavy discounting by rival retailers cut into Best Buy's holiday sales, which are a crucial earnings period for the electronic giant. Chief Executive Hubert Joly, who was hired in 2012 to revive the Best Buy chain, said that the retailer would sacrifice profitability to match rivals' discounts. However, the strategy came at a higher cost than expected in lost numbers. Now, the company projects a decline in its fourth quarter operating incomes. Well, there you have it. As always, we'll be tracking these stories and keeping you posted on all the latest. Our next guest, Peter Schiff, believes the U.S. is addicted to debt, moving from one quick fix to the next. Now, at the top of his list of entities enabling this addiction, the Federal Reserve. Peter Schiff, an investment manager who predicted the 2008 crisis, joins me now to talk about debt, government debt, and above all, the Fed. Now, I have to say to you, Mr. Schiff, welcome to Boom Bust. Let's talk about the Fed. Now, to the surprise of many, the Fed went and tapered its large-scale asset program, otherwise known as QE. I want to ask you, why did they do that?
Well, first of all, people were expecting the taper to start a lot sooner, and they really haven't tapered much. I mean, we really don't know what they've done, but I believe that they are not going to follow through with a tapering timetable. What they're more likely going to do is increase the amount of monetary stimulus that they inject into the economy. They're going to be doing a lot more than $85 billion, not less, and it's not good that they're doing this. It's bad, but it's what the Fed's going to do because it's the only way to keep the bubble from imploding.
Now, will the economy weaken so much with QE that the Fed is forced to relent?
Yeah, well, you remember, it's not the economy that's strengthened by QE. The economy is actually inhibited by QE. Quantitative easing is preventing a badly needed economic restructuring that would enable the U.S. economy to actually grow. Instead, what we're doing is we're pretending that there's growth by inflating bubbles in assets. We've got a stock market bubble, we've got a real estate bubble, and now we can take that phony wealth and we can turn it into consumption through debt. And that's what's going on. But it's not legitimate economic growth. You can't confuse the two. This is all phony, and it is the result of this monetary illusion that's being created by the Fed, but it will end. Just like it ended in 2008 with the financial crisis, that was the byproduct of the bad monetary policy of Alan Greenspan. Well, that blew up on Ben Bernanke's watch. Ben Bernanke's monetary policy is even more reckless and irresponsible than was Alan Greenspan's, and it's all going to blow up on Janet Yellen.
Now, one thing that's been said about QE is that it's just a form of trickle-down economics. The banks get the money and prosperity. It's supposed to trickle down to everyone else. Do you agree with this?
Well, you know, it's not like it's not going to work. I mean, I don't like maybe calling it trickle-down government or something like that, or trickle-down inflation, that somehow if we create a lot of inflation and let Wall Street financiers get rich, that it's going to benefit everybody else. It's not. What we need is legitimate capitalism. We need real wealth creation. We need increased production. We need good-paying jobs that might come from a vibrant economy. You don't get that when you just have cheap money sloshing around the banks. You have some people getting rich based on this, but it's basically at the expense of the broader economy, and it prevents legitimate economic growth from taking place.
Now, speaking of real wealth creation, let's talk about bonds for a second. Now, where are Treasury yields headed from here, in your opinion?
Well, eventually they're going to go way up, but the Federal Reserve is going to do everything it can to delay that, because the only reason that we can pretend that we can afford all this debt is because interest rates are so low. Now, we can't pay any of the money back, right? It's impossible for America to repay what it's borrowed, but we can pretend that we can afford the interest as long as the Fed has got it so low. But when interest rates go up, that's when we have to admit that we're insolvent, because we won't be able to service the debt, let alone repay it. But the Fed is going to try to postpone that day of reckoning as long as it can. But the problem is, the only way the Fed can keep interest rates artificially low is to print a lot of dollars and then use those dollars to buy up the bonds. At some point, the world is not going to want to absorb all those dollars. The bottom will fall out of the dollar on the foreign exchange markets. We will have a currency crisis, and then the Fed can't play this game anymore. Now the Fed is going to be forced to do the right thing, but it's going to take the discipline of the markets to do that, because they have no integrity on their own to do it.
Now, your comment, it actually segues very well to my next question, and that's at what level do you think higher Treasury rates become a problem for the U.S. economy and the Fed?
Well, I mean, I think anything higher. I mean, we're already having a hard time with the 10-year near 3%. You've already seen how that affects the housing market. But if short-term rates were to go up, I mean, the Fed still has short-term rates at 0. But if we had short-term rates at 2 or 3% and longer-term rates were maybe at 4 or 5%, we can't afford those rates. The government can't afford to pay that kind of a rate on the national debt. Homeowners can't afford it. Corporations can't afford it. We're all so levered up that we need rock-bottom interest rates just to survive. But, you know, that's all we're doing. If you look at the U.S. economy, look at the numbers that have been coming out of the retailers. Horrible sales during the holiday season. Even with all this cheap money, Americans are still broke. Even though the Fed has managed to get housing prices up, a lot of Americans don't own their homes anymore. They lost them to foreclosure. They're renting out houses, and rents are rising. The people who have been buying houses are hedge funds and private equity funds that pay all cash because they get it from the Fed. These houses are sitting vacant because nobody actually lives there. Meanwhile, stock prices are going up, but most Americans don't own stock. All they have is rising food prices, rising energy prices, rising health care prices. They're broke, and all this cheap money isn't helping them. It's actually making it worse.
So you'd obviously not advise the Fed to raise rates, but my question is, do you think that the Fed would potentially use negative interest rates? Would we see that at all?
No, I do think we need higher interest rates.
You do?
We need much higher interest rates. But I'm not delusional. I know that if we have higher interest rates, we're going to have a stock market crash. We're going to have a real estate market crash. But unfortunately, that has to happen. The biggest problem with the U.S. economy is that interest rates are too low. They have to go up, and the economy has to restructure in response to that. But right now, we have this phony economy that we just borrow and spend. We're not saving and we're not producing. All of our resources are misallocated because of the Fed. Now, fixing that is going to be painful. We're going to have to allow a restructuring, and interest rates have to go up. But the reason the Fed will not let interest rates go up is because they don't want any of that short-term pain, even if it means a lot of long-term gain. And of course, the most pain is going to be felt at the federal government, because when interest rates go up, you're going to have massive spending cuts coming out of the federal government. They may even have to restructure the debt where they admit that they can't pay. But the Federal Reserve is trying to prevent the government from having to do that. And so they keep interest rates at zero, regardless of how much damage it's doing long term to the U.S. economy.
Right. Now, there's a lot of banks with a lot of bad debt on their books. And it's not just here in the U.S., it's in Europe and elsewhere. How do these banks get rid of these bad debts, especially if central banks are raising rates?
Well, you know, the debts are going to default. I mean, that's how they're going to go away. But the governments don't want that. So they'd rather inflate the debts away by creating money. And what they're also doing is trying to lay a foundation where they're creating the idea that inflation is good for us, because they're trying to scare us that somehow if central banks don't create inflation, that we might have deflation, as if falling consumer prices is actually bad news. That's good news. You know, falling prices are good, but they're trying to convince us that they're bad because, you know, prices went down during the Great Depression. Therefore, falling prices must have caused the Great Depression. That's nonsense. That's like saying that wet sidewalks caused rain. The fact that prices went down during the Depression was a good thing. If they didn't go down, the Depression would have been even worse. Or they look at Japan and they say, well, prices are going down in Japan and their economy has been bad. But falling prices have nothing to do with that. Falling prices are a bright spot in the Japanese economy. If they were going up, the situation would be worse. But the central banks are trying to get everybody to irrationally fear a good thing, falling consumer prices, so that they can create inflation and we won't complain about it. But the real reason they need inflation is to wipe out all of their debt and to sustain all of these, you know, phony bubble economies that they've inflated.
Right. Peter, thank you so much for your time. And we finally tracked you down and got you on the show, but I wish we had more time with you. Please come back soon and talk more.